Let me tell you about the 2008 financial crisis, one of the biggest economic disasters in recent history. It all started in the US housing market. For years, banks were giving home loans to almost anyone, even people who couldn't afford them. These loans were called subprime loans because they were given to people with poor credit. But why would banks do this? Simple. They wanted to make quick money. They thought that housing prices would always go up. So even if someone couldn't pay, the bank could easily sell the house for a profit. But here's where it gets tricky. The banks didn't keep these loans. Instead, they bundled them into packages called mortgage backed securities and sold them to investors like pension funds or hedge funds. Now, these investors were happy because these investments seemed safe and offered steady returns. But in reality, these loan packages were full of risky loans. Nobody realized how bad things were until people started failing to pay their loans in 2007. Housing prices stopped rising and even began to fall. Suddenly, those risky loans turned into huge losses for everyone. By 2008, things were falling apart for major banks and financial institutions. One of the biggest shocks came when Lehman Brothers, a huge investment bank, went bankrupt. This sent shockwaves through the whole financial world. Why? Because banks and companies all over the world were tied to each other. When Lehman collapsed, it was like pulling out a block from a giant Jenga tower. The whole thing started to crumble. People began losing jobs. Businesses couldn't keep running. And economies everywhere started to crash. It quickly became clear that this was no longer just a problem in one country. It was a global crisis affecting everyone. Governments stepped in to stop things from getting worse. They gave banks bailouts, introduced new rules to control risky practices, and lowered interest rates to help businesses. India, for example, didn't suffer as much because its banks were more cautious, but it still faced lower growth and fewer investments. By 2008, the damage was so widespread that the crisis became known as the Great Recession. Why? Because it was the worst economic collapse the world had seen since the Great Depression of the 1930s. The effects were devastating. Jobs were lost, homes were foreclosed, and businesses shut down. And even today, we can still feel its impact. Banks are now more cautious about how they lend money, and investors are more careful with where they put their money. The lessons learned from that time have shaped how financial systems work to avoid another disaster like that. After everything that happened, the 2008 financial crisis taught us some hard but important lessons. It showed us the dangers of risky lending, the need for stricter rules in the financial system, and why banks need to be closely monitored. To make sure this never happens again, new laws like the Dodd-Frank Act were introduced. These laws were designed to create safer financial practices, protect consumers, and prevent banks from taking such dangerous risks in the future. That's the story of the 2008 financial crisis, a mix of greed, bad decisions, and a hard wake up call for the world. Until I come up with the next topic and recording that should be known to many, adios.